In this presentation, we will take a look at self-employed Schedule C income. When considering self-employed income, we're thinking generally of sole proprietors that report their income on a Schedule C, an attached schedule to the Form 1040 that is then used to carry that information forward to calculate total taxable income for the Form 1040. When considering the schedule, for more accounting information and accounting courses, visit our website at accountinginstruction.info. C income, we're talking about trade or business activities. Trade or business activities is a term used in the tax code often, but does not have a very specific definition for it. In general, it seems to imply that any activity that is engaged in for profit is trade or business activity. So in essence, if we're talking about a Schedule C type income, we're talking about basically anything, any activity that is engaged in for profit. This is not as easy a term as we would think because it's possible for us to get income from other items such as a hobby. A hobby is going to be an activity that is engaged in for sport, recreation, and not for profit. If we are considering an activity and trying to consider is it a trade or business or is it a hobby, really we're thinking about this for-profit motive. Notice that there's incentives or benefits and cons or pros and cons to either category. If we are talking about a trade or business, then we get to deduct the related expenses to it for that trade or business on the Schedule C. A hobby does not have that same benefit. The deductions related to a hobby are severely limited. So the fact that we get to deduct the expenses related to trade or business activities, huge benefit to be categorized as a trade or business over a hobby. On the other hand, if we have revenue over expenses for that trade or business, we also have to pay the self-employment tax on that. That's going to be Social Security and Medicare, both kind of in essence the employer and employee portion. So that can be significant as well. So there's benefits both to being reported as either a hobby or a trade or business. Where the IRS is going to be most concerned, of course, is going to be those areas where the expenses are greater than the revenue, which is quite often the case. In other words, we have a loss on our business. Why is that important? Because we usually take that loss and we write it off against the W-2 income. We lower some other income sources with the loss from our trade or business. That's okay as long as the trade or business was done for profit as a profit-seeking activity. If, on the other hand, we have a hobby where we actually got some income from the hobby, but we weren't really expecting to get a profit from it, and then the IRS is going to say, well, you have a hobby that's engaged in for recreation, happen to have some income, and you're writing off the loss against other income. That's what the IRS will be concerned about. In other words, if we have a loss on a trade or business, it's not a problem as long as we can prove that it is something that is engaged for profit. It's very normal to have losses for the first couple of years. That's quite possible, but we have to be ready to be able to prove that it is something that we are engaged in for profit. And if we can't prove that, then we're in danger, of course, the IRS saying that this is not a business but a hobby, and then reduce or eliminate the losses for it and have to record the income and have severely limited amount of losses that would be reported. Business income will be reported on the Schedule C, and then that net income, that net business income, will flow to the 1040. Types of income will include sales to customers. We're talking about sole proprietors. So sole proprietors may have sales to customers, may sell merchandise. We might have work performed as a contractor. Contracting is going to be a common type of sole proprietor business. And when we have contracting, we often see a Form 1099 miscellaneous. What we need to be careful of when we have a Schedule C business is that we have to keep the books more than if we were an employee, of course. If we're an employee, our taxes are basically done for us. We're forced to do our taxes. By the employer is required by law to take the money that we earn, pay part of it to the IRS in the form of withholdings, and then report to us the W-2 income. When we do our own taxes or our own business, it's a little bit more confusing, of course, because now we don't have that type of reporting. We may get a 1099 miscellaneous, which is kind of similar to a W-2 if we were an employee, The 1099 miscellaneous is something that whoever paid us as a contractor is required to give us. If we did work for more than $600, then we would typically need a 1099 miscellaneous. So just note what the IRS typically tries to do here. They try to force the payer to tell the IRS in some way who they paid, because whoever they paid should be reporting income. In other words, if we're an employee, an employer, and we pay the employee, the IRS forces the employer to tell them with the W-2 that they paid the employee, so that they're aware that the employee has income. When we're talking about a small business, it's harder for the IRS to do that. They try to do that. They're going to say, under certain conditions, if you pay a contractor, you're required, especially if you're a business, you're required to tell us with a Form 1099 and them, so that we know that they have income and should be reporting it on their taxes. However, the 1099s we get may not be all of our income. And so, for example, if we work for people that are individuals as opposed to companies, we're less likely to get a 1099 and still should report the income. So if we work for, if we do service work as a contractor for other companies, in other words, they're very likely to give us a 1099, and we'll be able to kind of check that out, and that'll be part of our gross income. If we work for individuals, if we do individual work as a contractor, if we do stuff, if we're working a salon or something like that, individuals probably aren't going to give us a 1099. Doesn't mean we shouldn't be reporting the income. We still have to track the income. So the 1099s could be helpful for us to know what income that we have from certain individuals. However, we should be tracking our own income and recording whatever income we have earned. The 1099 income we receive will be something that the IRS knows for sure, because the 1099s are going to both us and the IRS. But even though the IRS does not have 1099s for all receipts, we still need to record the receipts on the taxes. Here is a 1099 miscellaneous, and basically we would just have the 1099 miscellaneous and the non-employee compensation of some kind within the 1099, and that'll be the information we will have. We'll get a copy of this for us, and again, a copy of this will go to the IRS as well. So the IRS will expect us then to have some income on our Schedule C in some format or somewhere on the tax return. And if our income doesn't add up, the gross income, to the sum of the 1099s that we have that have been applied to us, the IRS's system can pretty much automatically, through a systematic way, match that up and say, hey, you didn't report the income. We should see income equal to or greater than the sum of the 1099s that are in your name, your social security number, or the EIN number for your business. Here is the form Schedule C. So we've got our information up top on the Schedule C. And then, of course, the Schedule C is, in essence, going to be an income statement. So the first half of the Schedule C will be income. And then we're going to have the related expenses in Part 2 of the Schedule C, giving us that net income or net profit on line 31, net profit or loss. That will then typically go to Schedule 1, which is part of the 1040, part of what will be included in the taxable income. Note what is not on the Schedule C. We don't have the balance sheet. So we're not doing like a double entry accounting system where we're going to have something that's in balance. We don't have assets equal liabilities plus equity. All we have is part of the equity section. We have the income statement. So we're not going to have something that's balancing here. We have a simple kind of equation, which is going to be the gross receipts minus the expenses. And so that's going to be and that'll give us our net taxable profit on the Schedule C that will then carry forward to be included in the 1040 taxable income. We also then have in Part 3 a calculation of the cost of goods sold if we are using and selling typically some type of inventory, some type of product. We then have information on the vehicle, and the vehicle is also often going to be something that will be needed more documentation, because we need to know if we're using the actual method. We need to know if we're using a vehicle that is for both business and personal use, or if it's just for business use. Are we using the mileage method for it? And then we have the other type of expenses where we can list out those expenses that weren't in the line items that are given to us in the part 2 of the Schedule C. So part 2 of the Schedule C will give us the kind of standard things. And then if we have types of expenses that don't seem to fall into these categories, we have another category down here, which is the other expenses. For more accounting information and accounting courses, visit our website at accountinginstruction.info.